Want to see someone else's Trading212 portfolio? Let me show you mine. In all seriousness, what I thought I'd start doing is do a monthly video, a monthly recap where I talk through some of my recent investments, recent changes to my portfolio. But as we said, this isn't something to copy. This isn't the world's best portfolio, and this is not trading advice. This is just me being honest with what I invest in and having a talk about it. And I think hopefully we can spark some interesting conversation in the comments, and we can see what we're all investing in. Obviously, towards the start of the year, we had some of the stuff with Trump and all the trade tariffs, and that sort of really did shake the stock markets for basically the whole world, especially US markets. But obviously, that through globalization has a big knock-on impact. And then since then, things have really stabilized. It doesn't seem like there's a whole lot of volatility at the moment. Obviously, the stuff with some of the wars in Israel, Palestine, Iran, etc., some of the bombings. But what we've seen is the market be relatively resilient in spite of that, and even things such as oil prices maybe not moving as much as we had thought. I've put my Trading2 up on screen. We can see I'm up to nearly £25,000, which I've put into the platform. Most of that I hold cash, and that is, as you'll see here, I've got 17,000 in cash, and that is mainly due to the daily interest that Trading212 pays. It is relatively safe. They do safeguard your assets, and they are FCA regulated, and it's just an easy platform to put money into. So for me, Trading212X is a way of getting 4.35%, or used to be 4.6, or used to be 5.2% daily interest, and that's worked for me. But if you look back and see my other videos, you would have seen that I would have had less invested. So I've been DCAing in, dollar cost averaging, which is essentially a low risk way of, or lower risk way of investing, where you put in relatively consistent amounts over a long period to buy at highs and lows, and eventually get yourself sort of the average by the average price, and that reduces the volatility of your portfolio. So that's what I have been doing. So if we go on my instruments and on my long-term growth, we'll see that here where the balance has gone up and up slowly over time. This has been from the start of Feb, and I am up £216, which is not a huge amount. But if I would go onto my app and look at my realized profit and losses, so everything that I have actually sold, I'm down about £500. So this is not amazing returns, but it is doing better than my previous strategies, which was essentially swing trading, which is holding for a few days to a couple of weeks. And that was when I was really, new and emotionally investing and not riding out lows, and I was, getting losses. But through this approach, I've had a lot more consistent returns, which has been very positive. And as this is a pie in Trading212, which I have a video specifically about if any of you don't know and want to know about how to make a pie. But essentially, that's just a pool of assets that you can set up auto invest and invest over a long-term period. But what I've been doing, I did initially have auto invest on, but with things such as bank holidays, the auto invest doesn't work overly well. So what I've been doing is every Monday, I've just been putting in some money and doing it throughout the week, in line with the ratios of my portfolio whenever I've seen dips or whenever I think it's a good time to buy. So we can click on this here. We can see if I look at the last month, I made £140. The last week, 116. Last 3 months, up 364. So we've seen, the last few months have been relatively good. What we had before that was the Trump tariffs, which were, I believe, in February, early March, was when we had a lot of volatility there. So what I've done is gone through that patch of volatility and come out of it with a profit over this extended period. Whereas if I'd done my previous lump sum investing tactics and swing trading, I could easily be at a loss now, because obviously the S&P 500 has recovered to its all-time highs, but due to the FX between the USD and the GBP, the S&P 500 instruments that are not FX hedged are not at all-time highs. In fact, we are quite far below, sort of 7-8% from all-time highs. So could easily be down 7 or 8% on this investment, but no, as we can see, my average buy price is 83, and we are up 3%. So that is why I'm DCAing as a long-term investor. But you can definitely make shorter, quicker returns without doing DCA. But if you're in it for the long haul, like I am, this I think is the way to go. But obviously, this is not investment advice. So if we have a look at this, if I keep moving it along, we can see I was £136 down at one point, and as low as £300 down off 2,300 of net investments, which we've recovered to being £200 up, which I think is not too bad going. I've turned auto invest off, as I say, dividends I reinvest, and the balance score is 10, because I adjust that every time I put money in, make sure that it keeps the portfolio balance that I've requested. And let's get into that right now. So these are my investments. So the S&P 500, I think, goes without saying. If I actually, I can show the pie later, the percentages, but it's here anyway. 23% in the S&P 500. I did previously have more in that, but I toned it down. I want this pie to be relatively diversified geographically. But obviously, the S&P 500 is a benchmark fund, so I've gone with 23% in that, 20% in the Nasdaq, which is obviously tech heavy. Still think that is a growth industry for many years to come, and feel confident putting my money into it. I've got 20% in there at the moment, that's another relatively US heavy fund. They don't show it on Trading212, but that is largely US heavy. So there's quite a bit of US exposure here. FTSE 100 is a more recent addition. I've not historically invested in the FTSE due to its returns not being as good as the S&P 500, but given the volatility with Trump, I think it's a good way of hedging some of his movements in the US space. And there are some, if I go to the fund allocation here, we do have some good sort of defense stocks and other things that have been doing well as of late. You got, Rolls Royce has been a very strong company really recently. Things like HSBC, AstraZeneca, some large growth companies. So I am happy with this, and this isn't tech heavy, which is a benefit versus the US and the Nasdaq, which are heavily tech heavy. So next, I'll move on to the DAX, which this has been, I think, the best performing instrument here, up nearly 5.5%. This was one I got into, I think, at the beginning of April. And this is the German stock exchange, which has done very well recently and doesn't show it here, but it's companies like Rheinmetall. It's a lot of automotive companies which have struggled as of late, a lot of defensive stocks which have, in terms of machinery, weaponry, things like that have done very, very well recently. But overall, the DAX has done very well, up 31% in the last year and up 9% in the last 3 months. And I think for me, this is one I'm confident in over the next year or so to put some money behind. Continuation of that, we have the stock Euro 600, which is top 600 European companies. So this is there was a decent European element to this portfolio, which I think historically, the last 5 or 10 years wouldn't have got you great returns. But I think at the moment, I think investing into Europe a bit more is not a bad thing. We can see here in the last 6 years, we're up 70%, so pretty good. But it's not done as well as some of the other jurisdictions. But over the last 2 or 3 years, we've seen really consistent growth in this. And it's not as tech heavy. There's a lot of financial companies, same as the UK FTSE 100. Automotive companies, things like that, which is really good diversification for the portfolio. So I have 10% in the FTSE All World also, which hasn't done as well, which looking at this year, going back to 2019, as the stock 600. But the FTSE All World is another popular stock. It is in theory the world's most diversified stock, essentially tracking the world, though with in Trading212, if we now go to countries, we can see it's 63% in the United States, and it is very, very highly correlated to the S&P 500. And again, it's tech heavy. So, this is really, for all intents and purposes, very similar to my other US holdings, which with the NASDAQ, with the S&P 500, and this takes me to around about 50% exposure to the US, which I think is enough. And then I can diversify in other ways across some of these other areas. The oil world has a dividend yield historically of 2%, which is quite strong. I don't think it says for some of these, but a couple of them do also pay dividend yields. I think this one does, which is the next one I'll talk about, which is the MSCI China, which is one I only added this morning. And that pays a dividend yield of 2.3%. And this is one that I only have 6% of my pie in, but I feel like it's decent bit of diversification. I think China has struggled at times due to Trump tariffs, things like that. But we are up 30% in the last year, which is very similar to how the DAX has performed. Um, but it does tend to be somewhat volatile. But I think over the next 5 or 10 years, I feel like the MSCI China is a very safe investment, I feel like, for the long term. Because a lot of, it doesn't show it here, but it's things such as Alibaba. There's a lot of fairly recent companies with a lot of scale and a lot of potential to grow. And I think that they can be very powerful and become even bigger than they are over the next 5 or 10 years. So I'm happy with exposure to that. And this also feeds into the FTSE emerging markets, which is I have 5% in. This has not been a great performing stock over the last 5 years. You can see we're only up 9.6%. Dividend yield of nearly 3%, which is relatively on the strong side. But this mainly is diversification. I think this has periods, the emerging markets, where it does well, and then it has prolonged periods where it doesn't really do a whole lot. Though I think it's 5% of the portfolio that are it is useful to have it in here. It's useful bit of diversification, but I don't think that this will be the main driver of growth in my portfolio in the long run. But here we are, fund allocations. So we can see Taiwan Semiconductor, Tencent Holdings, Alibaba, Xiaomi, for example, is a large phone company, tech heavy, finance heavy, quite a bit of consumer discretionary. So I think this is relatively diversified stock, and we again see China, India, Taiwan, which is semiconductor heavy. So I think it is good diversification. The opposite of this is the developed markets ETF, which I think I cover off through some of my other holdings. So I think having developed markets is a useful thing. And we can see here that over the last few months, the MSI China I've had since this morning, but the rest of them have all had returns of over 2%, which is positive. That beats what um, beats what I would be getting in a bank, which is um, very positive. So happy with that. And where I'm in Jersey, it is tax efficient to get your returns via this way rather than the bank. So I am happy with these returns as they are. Hopefully, the pound weakens against the dollar in terms of some of my S&P 500 and other holdings that would be beneficial. But I think otherwise, this is doing roughly what it wants to, or what I want it to do. You may have also seen this earlier, but I do have a very small holding in B&M, which previously I haven't held single stocks. I've been just ETF focused. This was just something I was doing this morning just to test how that works and how pre-clearance works with my company or my employer. But ETFs will be the main focus of this channel. But you may see me post some videos on some single name stocks, and maybe we try a few things out on there and see how everything stacks up. But anyway, I hope this video has been helpful, interesting, informative. If you have any comments, please put them below. Please obviously like, subscribe, share this video. All the engagement really helps. Anyway, it's been Harry from HL Finance. I'll see you next time.